Good morning and welcome to this Monday, April 4th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, some interesting stories, I guess, to start the new week. We did open up April on Friday, so we got a new trading month. April tends to be a very strong month for the stock market. This year has been a little different than most, though, the way we've gotten started with the big drop, big rally back. So April, I think, could be a tipping point one way or the other. It either, I think, launches us higher, or maybe back toward the highs anyway, or it, we see the reversal as we head toward earnings season. So there's going to be a lot, I think, going on. We had Elon Musk coming out announcing that Tesla is taking more than a 9% stake in Twitter. Twitter shares up about 24% last time I looked this morning. So pretty good action there. That certainly won't hurt the tech area and communication services, internet stocks. You would think would probably get a little bit of a lift from that news after really being beaten down throughout much of 2022 so far. That's one of the groups that really has had problems getting going, the internet space. So we'll see whether or not that helps to light a spark in the group. I always feel better about the market moving higher when we have areas like internet and software and, computer hardware, semiconductors, those types of areas where we see, where there's a lot of risk involved. When the market shows a lot more appetite for risk, those are things that help us drive the market higher. So anyway, got a little bit of good news there. Futures are up slightly this morning. We'll see whether or not that sticks. But let's go ahead and I'm going to take you over to the website, earningsbeats.com, where you can join us. All you do is go over to earningsbeats.com, scroll down. You can click right here on our on our homepage. You can just type in your name, email address, hit that subscribe button, and we will get you set up for our EB Digest. I know we got a couple of giveaways coming up this week, so if you're not already a subscriber, that would be a reason maybe to join in. I believe today we're giving away our strong earnings chart list, which is something that I work pretty hard on. I think it's our flagship product, to be honest. It's where we marry up fundamentals and technicals to produce a chart list, an organized chart list of companies that have beaten Wall Street estimates as to both revenues and earnings per share in their most recent quarterly report. They're also liquid. So we do a little vetting, make sure that they're liquid for our members. Normally, we don't allow any stocks to be on that list unless they trade at least 250,000 shares a day. And then also, we want to take a look at the technicals. So how is the stock trading versus its peers? How is the stock trading versus the S&P? How is the stock trading just period on its chart? Are we trending higher? Are we trending lower? I mean, generally, most of these stocks are going to be very strong stocks, or they're going to be within strong groups. Usually it's one or the other, hopefully both. That's what we strive for, is leading stocks and leading industry groups. So anyway, that's going to be one giveaway. I think on Wednesday, we're going to perhaps give away our short squeeze chart list. It's one of the things that I like to update at least. I try to do it every couple of weeks. They haven't really been in much favor. I mean, you probably remember back to when GameStop, some of those meme stocks took off. Actually, what's interesting about GameStop is it took off, I think it was in the latter part of January, and the September before is when we wrote about it in the Earnings Beats Digest, talking about it being such a high short squeeze candidate. Well, I wrote about one that was a short squeeze candidate this morning on the EB Digest. I'll probably write about another one on Wednesday, and then, of course, offer the short squeeze chart list up. That's 39 of the heaviest shorted stocks in the market. So it's a good idea to at least know which stocks are heavily shorted, because when they start to move, they can move really fast, because you have guaranteed buyers. Anybody who's been shorting, what they do is they're borrowing shares and then selling them. And so when the stock starts moving up, they have to buy those shares back and then return them to who they borrowed them from. So A short squeeze really is just a stock that starts moving higher, and it forces a lot of the shorts to cover or to buy their shares back. And so that's what triggers the short squeeze. Anyway, you'll want to be a part of the EB Digest if that's something that would interest you. Name and email address is all it takes. We get this out 3 times a week, Mondays, Wednesdays, Fridays. We'd love to have you. No credit card required. You can unsubscribe at any time. We also have free events from time to time, and we reach out to everyone that's on this newsletter with a link to the webinar. So it's always a good idea to be a part of this. All right, moving on to the action from Friday. Dow Jones Industrial Average finished up 140 points, S&P 500 up 15, NASDAQ up 41. On a relative basis, the Dow a little bit better. You can see 0.4%, 1/3 of 1%, and then about 0.3 of 1%. Mid caps and small caps both did a little bit better, though. Small caps up almost a full percentage point on Friday. So we did see across the board strength. All of our major indices finishing higher, a little bit of extra strength there in the small caps. Looking at our sectors, though, leading the advance, real estate, utilities, materials, staples, and the one laggard was one of the aggressive groups, industrials. So we're getting that strength. All the strength that we saw on Friday came in mostly from the defensive groups, and that was the case throughout most of the week last week. Real estate had a good week. Healthcare had a good week. Staples had a good week. Utilities had a good week. Those were our 4 defensive groups. That's what got us in trouble back at the top in late December, early January. And now we're seeing it again. We saw it again last week. So is this a sign that the market's ready to roll back over again? Well, we're going to talk some more about that in just a couple minutes, but certainly could be. 10-year Treasury yield. Let's make sure we got the latest here, get an update. Right now at 2.375, so not really down a whole lot, just pretty much flat. We gapped up a little bit this morning on the yield. Now we're back near the flat line. It's not really a whole lot going on there. As far as economic reports, this is a very, very light week. So if you're expecting the market to be moved by economic reports, well, you can probably take the week off. We have factory orders coming out later this morning. They'll be out at 10 a.m. The estimate there is for a decline of 0.6%. January actually rose 1.4%, but this is a report really in your rearview mirror. I mean, here we are, we're in April now, and we're talking about February factory orders. So it's not, market likes to look ahead. I don't think it's going to pay much attention to whatever the actual report comes out. Tuesday, we've got March PMI composite and the March ISM services. Wednesday, we'll see the FOMC minutes. So traders like to scour those minutes just to see if there's anything that they can glean out of there that maybe they didn't already get from the meeting itself. And then Thursday, initial jobless claims. And that's it for the week. I mean, there's just not a whole lot going on. So we're not going to get a whole lot of insight economically. It's really just going to be about the technicals this week. Hardly any earnings. So literally, it's just the market focusing on the news, the headlines, and the technicals that are currently on the chart. So we do want to pay attention to those for sure. So let's talk about the S&P 500 and what's going on here. So right now, here's the big rally off that March 14th low. That was option expiration week. That's where we talked about Max Payne and how I had never seen so many net in the money puts. Well, that put premium was eliminated. I didn't think we could get that much movement back to the upside, but we did. Shouldn't be too shocked. We've been through this many times before. But most of the advance occurred as a result of Max Payne and simply eliminating all of that in the money put premium that was on the table. Market makers had a feast. So that was your 3rd week of March. But then we did come back and followed through last week, which was pretty impressive, at least toward the end of the week and then into the early part of last week. Then Wednesday, we started to roll back over again. Now, this is the part, obviously, that we want to pay attention to. It was nice getting the rally, nice little move above that double top. Sometimes the market does that, though. We get these little head fakes. Here, we took the prior low out one day and then rallied back. Here, we took out the high one day, and then we started to sell back off. So you got to be a little careful. But we are in an uptrend. PPO, daily PPO looks good. AD line looks good down here. So you've got price action above the 20-day and above the 50-day. This all is very bullish setup. So what you would expect is any kind of a pullback to hold the rising 20-day EMA, which right now is at 44.68. That would be a number I would watch. Also, the last low, we had this one down day. We went back just a little bit above 44.50. I guess it maybe is 44.55. Let's take a look. It is, yeah, well, 44.56 was the close. So you got 44.56 on that close. You got 44.68 on the 20-day EMA. Those are going to be two levels that you want to hold. If you don't hold those two levels, I think that potentially opens us up for more selling. Now, when you go to an hourly chart, this is a 4-month hourly chart on the S&P 500. And one thing you notice is that for the first time since the rise began back on March 14th, for the first time, you see the hourly PPO go negative. So we saw enough weakness in the S&P 500 the last half of last week to see the PPO go negative. We also saw, as I mentioned earlier, defensive groups leading at the end of the week and throughout the week. So a couple of little short-term warning signs for sure. And now we've got a little technical breakdown here that we're gonna have to deal with. So I guess one of my questions is, can we get back up and through? There was gap resistance right here. I think that was around 45.75. I'd like to see a close back above 45.75. That would do a little bit, not only here on this hourly chart, getting back up above these moving averages, but holding on to the 20-day and moving to new highs on that daily chart I was just showing you would also be bullish. One thing you have to be careful about, though, is you see the 20-hour EMA and the 50-hour SMA are coming together here. And if we get that death cross to the downside and we have price action below the 20-hour, which is below the 50-hour, that's the configuration that led to our sell-off back in January and again in February. Once you get that cross and the 20 goes below the 50, well, here, back at the, it actually happened back in the early part of January. We came back up, tested it here, and then went back down. So this was a little bit different. This wasn't a whole lot of strength right here. Here we had a whole lot more. But it is similar to what we saw at the end of January into early February. Backed up, PPO went positive. We were trading with the 20 above the 50. Things looked pretty good. And then we fell back, rolled over. So watch to see. I mean, if we fail at these moving averages and then go down to another new low, then I would say we're going to want to be careful. We still have the daily. Remember, that's the, was it 44.68 I said on the 20? So that's over here. Right here's that closing low that I talked about. So if we can't get through on the short term, that would probably mean we're going to have that 44.68 test. 44.68, 44.56. If that goes, then I think we've got a configuration that's very similar to February and January. And that's when I would be much, much more cautious on the long side. And that's generally true anytime. I mean, when you're trading above the 20-day and the 20 days above the 50, I would tend to be more aggressive on the long side. And when it's below, I would tend to be more defensive. The one difference here in 2022 is that we were expecting the market to be weak. We're still seeing defensive stocks outperforming, and I'm going to show you some of those charts in just a minute. So this isn't, this outlook right here is not going to be the same as this kind of outlook back in July and August when we were moving higher and we had consumer discretionary leading and technology leading. I don't treat the markets the same. The markets are telling us right now, why is Wall Street going into utilities and real estate? We can't treat the market the same as we treated it a few months ago or 6 months ago. It's not the same market, not right now anyway. So we have to respect what's going on. Does it mean we're going to roll back over and go down to these new lows, or to new lows, or at least to test these other lows? I don't know. I wish I knew. I don't have a crystal ball, but I can tell you that the conditions are ripe for potentially another move to the downside. And so we have to be aware of it. When I don't even think, there's some who in uptrends are always thinking about, well, something's going to go wrong. Something's going to go wrong. I don't look at it like that at all. I'm just looking at it as something is going right now. I don't care about what's going to happen. Right now, the market's telling me that things are going right. I want to be on the long side. It's different now. And we just have to understand that. And we got to have some patience to get through this. I don't know what this is going to look like 3 months from now. Could we be at lows? We could. I think this rally has been strong enough historically and there's been enough buying in it, AD lines going up, that I don't believe we're going to go back and eclipse this low. I don't believe we will. Could we test it? Yeah, we could. And I think the short-term tests I'm talking about right now will help determine whether or not we go back down there. All right, let's move on and talk a little bit about the sectors. So here's technology. Now, this is on an absolute basis. I think it's pretty clear we have a triple top up here around 164. If you want this market to really get going, you've got to have a breakout in technology. The S&P broke out above that double top. Technology has not. So yes, we're trading above the 20, which is above the 50. We're just having a little pullback. Maybe that's all it is, or maybe it's the start of another down leg. Breaking out above that triple top would certainly put a lot more check marks in the bullish column. XLY. This one, we did get the breakout above that February high. Looks pretty good on the chart here. I mean, we're moving up. AD lines breaking out. I mean, everything looks pretty good. Just a normal pullback, right? Well, maybe. We'll get to that in a minute. XLC. Yeah, this one's a little weaker, but it is above the 20 and the 50, but the 20 is still below the 50, and we barely even got the PPO back above zero. This still continues to be a really weak area of the aggressive part of the market. Financials. Financials broke back down below the 20 and the 50 last week. I mean, it was an ugly week last week for the financials, especially the banks. Banks got hit hard. That's not a great look, by the way. I don't like to see the banks getting hit. Banks don't have to be your leaders. I'd rather have semiconductors and software leading. But I'd like for banks to go along for the ride. I don't want banks to be getting hit to the downside as we're trying to figure out whether or not the market's going to go lower or not. Industrials had a pretty good run, easily took out the double top from February, came back down. So far, I would just call it a 20-day test. But again, when we get into the relative strength, I'll show you some things here. Now let's look at defensive areas. Real estate, pretty nice move there. Look at that PPO, everything looking pretty strong there. Consumer staples, same thing. We're almost to an all-time high. Did you know that? Consumer staples almost to an all-time high. Utilities are. Look at utilities going crazy. Remember, these are defensive areas. Why are these groups breaking out while we can't even get technology to get to a 3-month high or a 2-month high? Makes you wonder. How about healthcare, another defensive group, not too far from its high. So the defensive groups are looking good. Now, in a bull market, I don't want defensive groups going down. I want all these groups going up. I just don't want them leading. A bull market is comprised of all of these sectors moving up simultaneously. Goes up in a bull market advance, or just about everything. So it's not that they're going up. I don't care. I want them to go up. It's that I don't want them to lead. And that's where we're going to get into relative strength. So let's talk about this for a minute. Technology. This is where it topped relative to the S&P 500, beginning of December. This still looks like, I mean, yeah, we bounced here in March when we had the rebound. So we've outperformed this month. But, I mean, we're still what I would consider in a downtrend. Look at that weekly relative PPO, still in negative territory. We got to get back up through the 20. We got to get the 20 turning up, the 50 turning up. We're not there yet. And like I said, technology on an absolute basis needs to take out that triple top. This isn't going to improve until we start to see better absolute price action on technology. Consumer discretionary. Look at this relative chart. We just went down and hit about a 2-year relative low at the beginning of March. 2 years. So yeah, some areas might be breaking to all-time highs, but this ain't one of them. Consumer discretionary, still very weak. Look at the 20 below the 50. This is, yeah, we're getting a nice little rebound here in March, but that's all it looks like to me. Look at the relative PPO, barely even budging back to the upside. Momentum, relative momentum here in consumer discretionary, very weak. Communication services. Remember I showed you that chart that didn't, the absolute didn't really excite me. Well, look at the relative chart. Talk about weakness. Everybody, and I mentioned internet earlier, internet's a big part of this group. Look at this. I mean, it's a free fall. I think the market is potentially prepping for a recession based on the way I'm looking at some of these charts. Industrials, Industrials were starting to strengthen. Look at March coming back down. Not really great. Look at that relative PPO rolling over right at the center line. Financials, my gosh, relative strength coming out. Those are your 5 aggressive groups I just showed you. Do any of these relative charts excite you? They shouldn't. They don't excite me. Now let's look at the defensive groups. Healthcare is above the 20, which is above the 50, starting to turn back up. Relative PPO looks really strong. Consumer staples, big breakout above the center line. Huge rally, pulled back at that 20-day, and now the relative strength is picking back up again. Real estate, right now at about, I don't know, close to a 20-month relative high and strengthening again. And then we've got utilities. Look at utilities ever since November. So you got the key areas of the market that are going one way to the downside, the aggressive areas, and then you got defensive areas going the other way. That's not a good look. Still not a good look. Like I said, utilities, real estate, staples, healthcare, I want them to go higher. I just don't want them to do this. I want the market to be going up. I want utilities to go up, but I want their relative strength to go down. That's not what's happening right now. Wall Street is repositioning in defensive groups, and that normally does not bode well for the market. All right, so let's go ahead and move on from that. All right, I was going to mention, I talked earlier about the short squeeze. This was the stock I featured today, by the way, in the EB Digest. Smile Direct Club. So what do I like about this stock? It's $2.58. It's been downtrending for a year. How can you possibly like this stock? Well, I wouldn't touch it right now. But there are some improving signs. And when you get a short squeeze, these stocks don't normally wait for you to jump on board. When they get going, they usually get going. They go fast. May not last for very long, but they can go very, very rapidly. Just look back here at October. Had this move up in what, 2 days, 3 days? Probably close to 40%. And the volume picks up. How about over here? $5 to 7.5, or a little over $5 to 7.5. What was that, 4 days? Look at the volume picking up. If this thing ever gets going, it could go very, very rapidly in a brief period of time. I mean, I wouldn't be surprised if we can get through this resistance and the volume starts to pick up. We could see a move back up into the 4.5, 5 range. Stock's $2.50. Now, before any of that happens, it might be a dollar stock. It may not break out. These stocks are being heavily shorted for a reason. So the only reason I would be buying them is on a breakout and a short squeeze possibility. I am not trying to bottom fish in a stock like this. I'm not trying to build a position. I mean, maybe that works for you in a short squeeze situation. For me, I just don't have the patience. I mean, if I started, looking for a short squeeze here at 5 and it kept doing this, and this, there's no way I'd be holding this stock all the way down here. I can't do that. That's not my cup of tea. But what we have seen here on this chart is multiple tests now up around 3 to 315. So I count 4 of them. If we break through 315, anybody who is shorted in the last 3 or 4 months is going to be underwater. So in order to cut their losses, what do? They buy. They have to buy it back. So if you get the breakout, a short squeeze a lot of times first gets triggered by the ones that came to the party late. They're thinking, oh, this thing's been going down, just going to go to 0. So let me just go ahead and make some money here. And then it starts to reverse and it breaks out, gets above a key level. And then they have got a big decision to make. I mean, if this stock were to get to $3.50 or $4 and you had just shorted it down at $2, I mean, you're selling at 2 and then you'd have to buy back at 4. You've lost 50% of your money. That starts to make you panic. And especially when you see it $4 at 10 a.m. and then you see it at $4.50 at 10:15, and you see your losses beginning to mount, you have no choice. I mean, at some point, you're just like, oh, I can't take the pain anymore. I just got to buy. That's what triggers a short squeeze. And then once you start getting up to 4 and 5, then all of these, anybody who shorted over here starts losing money. And that's what eventually can trigger these. So this is a stock that I would do nothing with. I would just simply have it on radar and watch. And maybe even set an alert at stock charts. You can do that. Just set an alert, price 315. If this stock hits 315, they'll send you a text message or an email or however you set it up. It's a great way to keep track of short squeeze candidates, because you just never know when it's going to happen. But I liked these 4 candles closing at the high every single day. Look at the 4th day, the volume picked up. So that tells me right there that, oh, maybe some shorts are getting a little nervous. Maybe a little short squeeze there. Very, very little. I mean, we haven't broken out, so I wouldn't call it a short squeeze. But look what it did to the AD line. Look what the AD line's doing. It's going up. We just went down and had a double bottom here. AD line's been turning up. So got a little good action there. And then this is SDC relative to the medical equipment group. So we're not too far. If we get one more move up, we could break out on a relative basis to about a 4 or 5 month high. So this is just one of the stocks on our short squeeze list. We put it in the Earnings Beats Digest newsletter today, featured it, and I've got a couple of others we're going to talk about on Wednesday. So again, if you're not already an Earnings Beats subscriber, go to our website, earningsbeats.com, scroll down and just fill that out and you'll be set to go. All right, one last thing I want to talk about today, and that's the inverted yield curve everybody's talking about. So I've set up 2 charts for you. The first one is the 10-year Treasury yield minus the 2-year Treasury yield. Normally, the longer maturities are going to have higher yields. And so normally, this difference between these 2 Treasuries, the 10 and the 2-year, normally the difference in the yield is going to be above 0. Here's the 0 line right here. I should have annotated it on here. But anyway, here's that 0 line. We got down to the 0 line, so it was just about ready to invert in 2019, and you can see we're doing it now. So as of Friday's close, we had inverted. The 2-year Treasury yield had come up enough to go higher than the 10-year Treasury yield. The reason that this is significant, if you're not familiar with the whole inverted yield curve concept, banks, if you think about their cost of funds, it's based on the shorter term maturities. So I've got the 2-year versus the 10-year here. I'm going to show you the 3-month versus the 10-year in just a second. I tend to like the 3-month versus the 10-year better, and I audited banks. I think that's a better representation. I'll show you a little bit of proof of that on the charts here in just a minute. But this is what you'll hear a lot of times in the media, 10-year versus the 2-year. And there's the inverted yield curve. We just went negative. Down here is the bank's relative performance to the S&P 500. And then down below here is the correlation between the difference in the 10 and 2-year yield and then the direction of banks on a relative basis. So in other words, we would be in positive territory above 0 when these 2 are going in the same direction. So in other words, when the 10-year minus the 2-year is going up, when that spread is getting wider and wider, banks tend to outperform the S&P 500. That's what this, anytime the line is up here in this blue shaded area, that's above positive correlation of 0.5 or 0.50, all the way up to positive correlation of 1.0. 1.0 correlation, positive correlation, means that if one's going up, the other's going up hand in hand, lockstep, going with it. 0.5 is still pretty good positive correlation, but it's not lockstep. You get down to 0 and there's really, up, it's a little correlation, and then there's not, then there is, and then there's not. And then if you get down the bottom down here, you can see there's inverse correlation. Well, I think if you look at the 10-year Treasury yield versus the 2-year, and then look at it, the banks versus the S&P 500, and then we do this correlation, I think you can see that we live mostly in the positive territory, and a lot of times up in this 0.5 plus range. So I think there's a lot to be said about what's going on in the yields between the 10 and the 2-year and how the banks perform on a relative basis. All right. Now I want to show you the same chart, but this time the 10-year versus the 3-month. And it's the $UST 10Y, that's the 10-year Treasury yield, minus $UST 3M, which is the US Treasury 3-month yield. Now, this yield, as you can see back in 2019, did go negative. But look what's going on right now. This isn't telling us that there's any problem. 10-year Treasury yield's pulling away from the 3-month. The short term, which is really the rate that banks borrow and what they lend out at, it's widening. So this is actually not looking that bad to me. And when I come down here and I look at the correlation and I see all of this action down here at the bottom above the 0.5 range, very positive. What I want you to do is I want you to focus on the number of times in the last 10 years that you've seen us go below zero. Really just right here, right? I mean, here was just a little bit, but for the most part, we've been above zero. Look at the 10-year versus the 2-year. It's not quite as tight of a correlation, right? So while the media is talking about the 10-year, 2-year, just beware that the 10-year, 3-month, which is a better, in my opinion, a better, if you want to know what makes banks tick, I think this, I just showed you in terms of correlation, this is better. This is the one we need to focus on. And this one's not bad. So let the media talk about the recession. Let the media talk about the 10-year and the 2-year and how it's inverted. This is the chart you need to pay attention to, because long-term, this is not a problem. So right now, banks are getting hit. I'm not quite sure why. I think they're making it the 10 versus 2-year inverted yield curve narrative. I think banks will come back. Now, whether or not we see it continue in the short term, I don't know. But I think we're going to see banks come back. That was my point there. All right, 3 you must see real quick. Market just opened a minute ago. Wayfair, these are just 3 old stay-at-home stocks. I think they were all stay-at-home stocks. What did I pick here? Yeah, for the most part. So let's take a look. Wayfair continues to trend down. Couple of problems here with Wayfair. Number one, it's in the home improvement space and money is rotating out of that group. It's also not a very good stock within the home improvement space. So you have a really bad performing group right now and a bad performing stock. We are down near, what I would say is pretty good support, close to 100, maybe at bottoms here, but you really have to be a true bottom fisher. If you're a momentum trader, you got to stay away here. It's too early. Zoom, I would say probably about the same thing that I just said there. Not a great looking group. You can see the group been downtrending here relative to the S&P. The group's near 52-week low. Zoom also near 52-week low relative to the group. Yeah, we saw a move back up to the 50-day. We've done that a couple of times before. If we have a definitive candle, big red candle back below the 20, we're probably going back down to the bottom. So I would still, this one's a little premature to be buying to hold for a move to the upside. I think it's just a little early. Roku, AD line is starting to talk a little bit different than the chart. So the chart still doesn't look much better than Zoom and Wayfair, but the AD line, this right here, all of this volume really sent the AD line up. And even though we had lower highs here, we had a higher AD line. So Roku is the one of the 3 that I think is starting to show a little bit more strength. And you can see this move right here in the computer hardware group. So, Apple's been obviously carrying this group, but Roku under the surface might be looking a little better than the other 2 I just mentioned, Wayfair and Zoom. All right, quick look at the market, see where we are here to open. Dow down 115, NASDAQ flat, S&P flat, NASDAQ up 47. So bifurcated market to open. We'll see what happens with that. VIX up a little bit here, volatility index back up above 20. I really think the opening here this month as we head toward earnings season is going to play a role here. Can we hold on to the key levels that I talked about earlier in the show? Do we break down? What's the makeup? Who leads in this market? Last week it was all about defensive sectors. That's not good. If we're going to go higher and we're going to break back out the new highs, we need something other than defensive groups leading. So I'm going to leave you with that. Tomorrow I'll be back at Stock Charts TV at 9 a.m. So if you want to watch the show at Stock Charts TV, just click on this link right here to Stock Charts TV at 9 a.m. and I'll have the next Trading Places live show going. Next live show that I do will be right here at earningsbeats.com on Wednesday morning. Love to have you there. And by the way, if you really like our shows, make sure you click on our subscribe button on YouTube and also like the show. Love to, get some more support. Tell your friends about us. Anybody you know about this, interested in the stock market. Love to have everybody tuning in. Anyhow, have a great day, everybody. Be back tomorrow. Happy trading.